When you saw meme coins going vertical again, that's always a little bit of a sign that the market's a little bit over enthused. I think a lot of that's worked itself out, and I think that now it's probably has a stronger base to build from next year. I am bullish over the course of next year on Bitcoin personally.
Lyn Alden begins by addressing a misconception prevalent in the cryptocurrency space, that Bitcoin's price movements are primarily influenced by its halving cycles. While halving events are important, Alden highlights global liquidity as the key variable driving Bitcoin's price direction. She defines global liquidity as the global broad money supply, denominated in dollar equivalents, a measure that considers global credit creation and the strength of the US dollar. Given that the dollar dominates global trade and much of the world's debt is denominated in dollars, fluctuations in the dollar's value have far-reaching consequences across markets. Alden's research demonstrates that Bitcoin has the highest directional correlation with global liquidity among major asset classes, while bonds have a slightly negative correlation due to their risk-off nature, and equities like the S&P 500 are positively correlated about 70% of the time. Bitcoin stands out. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So a lot of people focus on Bitcoin and the halving cycle, but one of the things I've been emphasizing for years now is that the strongest correlation I see with Bitcoin price is global liquidity. And global liquidity is kind of a topic. You could define that in multiple ways. The way that in this kind of research that we define it is global broad money supply denominated in dollar equivalents. And so that takes into account both kind of global credit creation, and it takes into account the dollar strength relative to other currencies. And the reason that's relevant is because, a lot of global trade is priced in dollars. The majority of, inter-country debt is denominated in dollars. And so that it's a unit of account that's very important, especially for liabilities. And so the strength of the dollar and the overall amount of dollar equivalent global M2 is really important for a variety of asset classes. And we ran correlation analysis and found that among all major asset classes, Bitcoin is more directionally correlated with global liquidity than any other asset. Now, when you just look at raw correlation, the numbers are messier just because Bitcoin's so volatile. But when we ask the simple question, if liquidity goes up or down in the next 12 months, the way we define that, which asset classes are most likely to go in the same direction? And there are some that have pretty low correlation, like bonds. If anything, there's a slight negative correlation because bad liquidity is generally, worse economic conditions. People pile into risk-off assets. There are other assets like the S&P 500 that are quite correlated with global liquidity. Over 70% of the time, they'll generally go in the direction of global liquidity. Whereas in our study, Bitcoin was the highest. At 83% of the time, it'll go in the direction of global liquidity. And that's, in my view, because one, it's still perceived as a risk-on asset by most pools of capital. And two, it doesn't really have confounding factors like earnings or ties to the economy. If anything, it's the most pure liquidity play we see out there. So on a week-by-week basis, I don't really have a firm view. That's more of a day trader type perspective. I do think that global liquidity has been basing for like 2 years now as central banks have been trying to tighten. But as we see the Fed start to ease, as we see other central banks start to ease, I do think over the next 12 months, liquidity is going to do pretty well. We already see it gradually breaking out of the base that it formed. And with Bitcoin, I think an issue is that it kind of pulled some of that forward with the ETF launch. The ETF launch was a very popular bullish event. And I think that some of what might happen throughout this year was kind of pulled forward all the way into February and March. Right. And so we have gone through this kind of multi-month period of doing worse than liquidity alone would say. But I think that once we kind of work out the success, and I think we're kind of pretty far in that process. I think we worked off a lot of the excess and a lot of the pre-enthusiasm. I am bullish over the course of next year on Bitcoin personally. When you saw meme coins going vertical again, that's always a little bit of a sign that the market's a little bit over enthused. I think a lot of that's worked itself out, And I think that now it's probably has a stronger base to build from next year. Markets are kind of in this pause where they're not really falling, but they're also it's unclear if they're going to be able to break out to major highs. Talking about the major equity indices. Outside of the gold market, a lot of other markets are kind of ranging. And one of my kind of major points that I've been making is I think the market is emphasizing the Fed too much. There's so much attention right now on two main things. Is the Fed going to cut 25 or 50? And, what's the path going to be for future rate cuts? And then the other one is whether or not the US is going to have a recession. And those are obviously very important variables. But I consider them somewhere like second place in terms of major things that are happening. And I've been kind of pointing out that if anything, China's ongoing economic malaise is probably the biggest factor in markets to watch. So, when I kind of look at the major headlines every week, I'm more looking along the lines of, has there been any change out of China, or is that still the kind of the same situation? That for me is like more important than saying, okay, what's going on in the U.S., what's happening going forward with the Fed, those types of details.
Although Alden emphasizes China's importance, she does not entirely discount the role of the US and its monetary policy. However, she believes that the market is placing too much emphasis on the Federal Reserve's actions. While investors obsess over whether the Fed will cut rates by 25 or 50 basis points, Alden argues that these decisions are less important than larger structural shifts in the global economy.
Right. So China is basically the biggest country in terms of trade partners. So they're the biggest trade partner with most countries in the world. 20 years ago, that was the United States. And if you kind of look at the map of country trade over the past 20 years, it's gravitated heavily toward China. They're a very physical economy, whereas the United States is a more financialized economy. And so when you look at things like steel production, infrastructure build out, manufacturing capacity, and kind of most other variables, they're a larger economy. And so whether or not they're running hot or running cold impacts countries worldwide and impacts global liquidity and impacts kind of global the pace of economic development and growth. And they've been in a economic malaise for the past couple years because they're going through a property bubble deleveraging. Similar to what the U.S. went through after the global financial crisis. And they have been reticent to do any sort of major fiscal stimulus. So whereas the United States, when we went into COVID and the aftermath, we were doing very large-scale fiscal stimulus direct to consumer. China's is much more reticent to do that, in part because one of their main goals is to internationalize their bond market and their currency market. They want more trading partners to accept their currency for payment, and then to hold their currency as bonds for some intermediate period of time because they know that they can use it to buy all sorts of Chinese goods, and they needed to hold their purchasing power to some reasonable extent in the middle, kind of like how countries use treasuries as reserves. And so they have these kind of conflicting goals where they want to hit their growth targets, their economic growth targets. And they want to have social stability. On the other hand, they want to internationalize their currency, so they want to play it rather austere in that sense. And right now there's increasing tension on Chinese social media about the state of the economy. There's basically just low domestic sentiment, even though their exports are very strong. And as one of the two biggest money supplies in the world, and as one of the two biggest economies in the world, I would say that to the extent that whether China does fiscal or stays in their malaise for another year, impacts most asset classes, ranging from commodities, global bonds, global equities, and then, yes, stretching into, Bitcoin and other assets. I think that's overall a bigger variable than the U.S., at least in this current time. It's not that there's always a bigger variable, but that basically whether the U.S. cuts by 25, 50, or 100 basis points over a given multi-month period, that monetary policy lever is less impactful than structural fiscal pivots and things like that out of a major economy.
For instance, while US monetary policy plays a role in shaping liquidity, broader fiscal policies and international economic trends often have a more substantial impact. The US may be able to tweak interest rates, but these adjustments are unlikely to outweigh the economic shifts happening in major economies like China. Thus, while the Fed's decisions are worth monitoring, Alden suggests that investors should focus on broader liquidity trends and structural changes in global markets when assessing Bitcoin's future price movements. Please like and subscribe my channel.